The United States stock market is one of the most powerful and influential financial systems in the world. Every day, trillions of dollars move through it, shaping not only the U.S. economy but also global markets. From retirement savings and pension funds to major corporations and everyday investors, the stock market plays a critical role in modern life. In this video, we will explore how the U.S. stock market works, focusing on four major names you often hear in the news: the New York Stock Exchange, the NASDAQ, the S&P 500, and the Dow Jones Industrial Average. By the end of this video, you'll have a clear understanding of what they are, how they differ, and why they matter.
Next, let's talk about the NASDAQ. The NASDAQ was founded in 1971 and was the world's first electronic stock exchange. Unlike the NYSE, the NASDAQ does not have a physical trading floor. All trading happens electronically through computer networks. The NASDAQ is especially famous for technology and growth companies. Many of the world's most innovative businesses are listed here. Examples include Apple, Microsoft, Amazon, Google, Meta, and Tesla. Because many NASDAQ companies focus on innovation and rapid growth, their stock prices can be more volatile. This means prices may rise or fall more sharply compared to traditional companies. As a result, the NASDAQ is often associated with higher risk but also higher potential reward. When people talk about tech stocks, they are usually referring to companies listed on the NASDAQ.
Now that we've covered stock exchanges, let's shift to stock market indexes. A stock exchange is a place where stocks are traded. An index, on the other hand, is a measurement tool. It tracks the performance of a group of stocks to show how a portion of the market is doing. Two of the most important U.S. stock market indexes are the S&P 500 and the Dow Jones Industrial Average.
The S&P 500, or Standard & Poor's 500, is widely considered the best indicator of the overall U.S. stock market. It tracks 500 of the largest publicly traded companies in the United States, covering many sectors such as technology, healthcare, finance, energy, and consumer goods. Unlike the Dow Jones, the S&P 500 is market capitalization weighted. This means companies with a larger total value have a greater impact on the index's movement. For example, companies like Apple and Microsoft have a much bigger influence on the S&P 500 than smaller firms. Because it is so broad and balanced, many investors use the S&P 500 to measure market performance. In fact, many retirement funds and index funds are designed to simply follow the S&P 500. When you hear someone say, "The market is up today," they are often referring to the S&P 500.
The Dow Jones Industrial Average, often called the Dow, is one of the oldest stock market indexes in the world. It was created in 1896. The Dow tracks only 30 major U.S. companies, including Apple, Boeing, Goldman Sachs, Johnson & Johnson, and Microsoft. One unique feature of the Dow is that it is price-weighted, not market cap-weighted. This means companies with higher stock prices have more influence on the index, even if they are smaller in size. Because it includes only 30 companies, the Dow does not represent the entire market as accurately as the S&P 500. However, it remains extremely popular due to its long history and frequent use in news headlines. When news anchors say, "The Dow jumped 300 points today," they are referring to this index.